The reason I wanted to have it be both myself and Michelle is because much of the insight for this topic that I've kind of messed around with for the past 7, 8 years has been as a direct result of getting to work with Michelle in a program that we have ongoing for a long period of time with ExxonMobil. And she really gave me a lot of insight in this, and so I wanted to bounce back and forth some ideas. I'd like to set the scene so that you understand why we're talking about what we're talking about with a strange title called Eating Cookies. And maybe that will kind of help us understand kind of where this is coming from. To start, I got to give you a little bit of my background because it's a bit of a mea culpa. So I'm technically trained and mathematically oriented, and most of my early career was around the idea of we've got a large risky capital project, we're trying to figure out how to budget for it, we're trying to figure out how to schedule for it, how do we appropriately take into account risks? And my driving idea behind that was the better we understood how to model risks and think about risks and take them into account in our economics, the better the decisions we would make. And then all of a sudden, I met Michelle, and we started working a lot with ExxonMobil, as I told you. And this interchange occurred. I'd like to talk to you about it, and it kind of sets everything up. There was a bid round on a very large, risky block, and both ExxonMobil and Shell were present in the bid round. And upon the accumulation of the bid round, this was overheard. The ExxonMobil executive said to the Shell executive, "Why do you try to eat every cookie on the shelf?" To which the Shell executive retorted, "Why do you guys pass by every cookie on the shelf?" Now, this is not going to be a discussion about ExxonMobil and Shell. That's just the genesis of this discussion, right? It's the genesis of this idea. How could two large companies, hey, they have all the analytical tools that we know to teach. They're very competent. The people who are making these decisions have a lot of experience. How can they look at the same data and come to drastically different conclusions about whether or not to engage in a risky decision? And so I was pondering this and talking back and forth, and I started talking with Michelle, and that's where this entire conversation came from. It's this idea that perhaps people make decisions not only or even despite the data and the analysis they've done, but perhaps there's some driving force that goes beyond that, corporate culture, if you will, or if you will, heuristics about how we make decisions. And I've just found this a fascinating discussion. So that's what the topic is about today. How do people seem to really make decisions in the face of uncertainty? And it arose because of conversations with Michelle.
So I started out in life as a scientist. I still am. Biology and geology. That was the best decision I ever made, was to slog through all of that stuff and get it done. The second best decision I ever made was to get my economics master's at Colorado School of Mines, which not only is a great place to be, but also Britt accuses me constantly of having the economics gene.
Yes.
And these things are not as far apart as you might think. What we observe a lot about humans and human nature and describe when we're working on economics problems and figuring things out is really the ecosystem. It's the economics ecosystem. And that gets dictated by how we are, not only how we're acculturated and socialized, but also how we are physiologically, how our brains work, how our brains function. What's happened in these conversations between Britt and I guess I should add that my terminal degree was a real adventure after a tour through investment banking. Okay, so here I am in investment banking in 1989. For those of you who've been around the block, and by the way, it's 40 years, unfortunately, for me, that have been around the block, not 30 years. 1989, what was going on in 1989? Anybody remember those wonderful days? We were reconfiguring the industry, just like we're trying to do right now, right? And so I was with an investment banking house in Houston, and what we were doing basically was rebuilding the oilfield services sector. I was at Simmons & Company International, and that was the big push in those days, was to try to rationalize that business. I went from there to finally getting my PhD done, but I ended up doing it in political economy, political science. Because the problem in all of this, to Britt's point, the way that people make decisions are often what we might consider political. I, as the person that's stuck with the economics gene, I want everybody to look at the data and look at the facts and make decisions that way. But that's not what happens. We interact, we start leaning on those things that we call heuristics, the conditions that we tend to use to make judgments and to make decisions, especially in the face of a lot of uncertainty, when we don't feel like we want to just trust the data, we want to trust our gut. We have a whole branch of economic thinking called behavioral economics. And what's been happening to me over these years that we've been interacting is I've been revisiting a lot of that stuff because I can see it in the companies that we work with, in our corporate classrooms, the cases that we have a chance to look at, the decisions that we get a chance to observe, sometimes to be a part of, or to pick apart when they're done. And what we can see is that a lot of things that people have learned over the years about how people think, physiologically, behaviorally, find their way into how we make decisions in spite of the training, the processes, the stuff that Britt drills into his students, every single day. And so that's the direction that I'm coming at. I look at this and I'm like, oh, of course people are going to make decisions in different ways. The problem is, how do we understand the process of that decision making and think about the implications of it?
Yep. Well, I think along what Michelle was just saying, have you ever been involved in an initiative? We want to do something different in our company. We've been doing it this way, and it's time to let's learn from this other company. Let's do it more like them. You ever noticed how they almost always fizzle out? And my observation of them fizzling out is because of that last one of my favorite quotes, and I really don't know where it came from. But the simple fact of the matter is, corporate culture eats strategic initiatives for breakfast. Okay, so you can do whatever you want. But if the corporate culture is strong enough, it will simply overwhelm whatever you're trying to do, which is important to me when I'm talking to people about trying to be analytical and rigorous and follow clear definitions of what they're trying to do, because it often falls upon deaf ears. So that's what we'd like to talk about. Again, we're not here to talk about the oil and gas industry per se. This is much more about, broadly speaking, these kind of decision heuristics. But it is important to understand that the oil and gas industry is a particularly interesting place where you can find these kinds of decisions being made, because the bets are so large. I mean, if you're talking about an offshore development or a new country entry strategy, you're talking about tens of billions of dollars. And there's these kinds of risks associated with it that are particularly hard to quantify. We'll see some data and talk about this later on. But by and large, the big, technically savvy oil companies are pretty good at managing technical risks. It's not to say they always get it right, but technical risks they can mostly manage because there's processes that work for that. They're amenable to quantitative analysis and risk trade-offs and things like that. The challenge is what we're going to broadly call non-technical risks. So for example, if we're considering doing a country entry into Papua New Guinea, where Michelle and I just were, and we're talking $20 billion, and it's a developing country, and there's political conflicts, and there's all sorts of interesting things going on. How do you take that into account in a decision? And you have to understand, this is what oil and gas companies face all the time when they're trying to look at these big projects. Anything to add to that?
No, I think every business has its complications. My pushback with Britt is usually, we do spend a lot of time looking at very large projects, but when you look across the industry, we have lots of different kinds of participants, right? Very large companies, very small companies, companies that are very integrated across all of the value chains. So not only do they produce oil and gas, but they push it through manufacturing, refining and chemicals. And they will sell intermediate and final products, and they'll capture the whole scale and scope of the business. Texas is full of smaller E&P shops, as I like to call them. They may be one guy in an office like my husband.
Yeah, exactly.
21 years
Like
of
her
Chevron,
husband.
and ends up, as a prospecting geologist, happier than he ever was, actually, while he was at Chevron, and he had tremendous experience there. We have something like 8,000 oil and gas producers in our state, right? So the problems aren't just about big projects and wrestling with technical and non-technical risk in big projects. The problem is for small companies, small businesses, how do you wrestle with the technical and non-technical risks in that environment? And how do you think about them and take them apart without maybe the luxury of the big analytics teams that large corporations have? I mean, this is so I think a lot of our thinking on this has really, over the years as it's evolved, I think a lot of what we're thinking these days can apply to both. You face very large risks on very large cap projects, but when you look across the scope of the domestic businesses, and it doesn't matter what it is, it could be oil and gas or it could be technology. And when you aggregate the activities of all of the business activities together, all of the market participants together, there are a lot of things about that aggregate that interact with our social frameworks and our economic ecosystem heavily.
Yeah, I buy that. I just still think a $20 billion project is kind of
fun.
sexy. Yeah.
It's fun, for sure.
All right. So the constant issue we're going to be facing here is this kind of balance between risk and reward, and how do you figure out how much risk you're going to try to address? Because of course, the limit is if you try to treat all the risks and make it go away, then you end up with a risk-free reward, which is probably not what most of us are looking for, right? So you're always going to have this balance of how much to leave on the table, how much to treat, what risk-reward am I looking for? So keep that in mind as we go ahead. This is the central issue that we're talking about. Michelle created this, so I'm going to have her speak to it because I think it's a very interesting kind of thought process about the economic analysis.
So let's go back to the cookies analogy for a minute. When Britt was teeing this up for me on how to think about communicating all of this to you today in some logical form, to me, I needed a framework. I needed a framework to think about it. So I think probably some of you are familiar with decision trees. Maybe you used them before and you've looked at them. I mean, you can go online, you can find free decision trees and play around with them. This is sort of a version of a decision tree because what I'm trying to figure out here is what happens to me when I'm faced with the cookies problem. Do I take the cookies? Do I take that cookie? Any other cookie? Do I leave it on the shelf? Well, fundamentally, I'm trying to decide whether or not I'm going to go forward with a business investment or I'm not going to go forward. Well, the important thing about all of this stuff, the probably the most strenuous dialogue that Britt and I had going back and forth about this conversation today, was the importance of exiting. Because we don't talk about that enough, but it's really true. If you are risk averse, you leave the cookie on the shelf. And you become very good at doing that, right? And part of the trick, though, is to have other opportunities. Because part of leaving the cookie on the shelf means, well, you're giving up that opportunity. You better have something that actually exceeds that cookie in potential value, right? So that's what's going on with the bottom one. The bottom one is fairly straightforward. Faced with a business decision, I'm a no-go. It doesn't feel right to me. It doesn't look right. My analysis doesn't support it. So I'm going to decline. I'm going to exit from the risk associated with that potential opportunity. And my view on my other opportunities, my competing opportunities, is that they are better for me than even what the result could be of going forward with that decision. But the top part of it is what happens to me if I do decide that it's a go and I want to go forward. I have to figure out, first of all, whether I can control enough of the risk to be able to manage the project, or what do I do with the things that I feel like I can't control? How am I going to mitigate those? So I'm in a risk mitigation process from the minute I get started. When we run our classes together, one of the little things that we do with our groups is we force them through this experiment. We toss out things, or we have them identify things. What is something that I think I can control? What is something that I think I can't control? I have an answer for just about everything that anyone could identify that they think that they can't control. There's always something that you can do to manage it at least, so that you can move it into the, it's in my active control column and it's no longer out here lurking around and haunting the project. So that's the first big hurdle. That's what I'm going to try to do. I'm going to try to move as much out of the things I can't control column into the things I can control column. And then I'm going to go forward with the investment, and what I'm going to try to do is make sure that if I'm going to stick it all the way out to completion of the project, that I am getting to a point where my risk management is good enough so that I can bring back returns to my investors, my shareholders if I'm a publicly traded company, that meet their expectations. This is the daily trick of a publicly traded international oil company, right? This is what you have to be able to do. You have to have confidence in your risk management process so that when you roll it all the way back, the business investment decision is one that was good for everyone involved in the corporation. So that's our framework for discussion.
So it's perfect timing right now. So this is where Michelle and I are constantly talking and kind of pushing against each other, because you have to remember, at the end of the day, if I were to characterize where we come from, I would characterize Michelle coming from the economic, big picture policy question of what we should be doing. And I would picture myself as coming from I have to work with that project director who's charged with getting this project through and making sure they deliver it. And it's really interesting to see the tensions between those two sides. And I mean this in a good way, a good kind of tension, not a bad kind of tension. So I'd ask you this question, those of you who are familiar with the oil and gas companies, just to kind of think about this analytical tool. Compare 2011 to 2017. It's really interesting to see what the pundits and what the people who are writing about oil and gas companies are saying in those two different times. Because you have two large, successful companies. Let's use ExxonMobil and Shell right now, okay? If you go back and look at what was being written in 2011, 2012, ExxonMobil was sitting on $100 billion. There was pressure that they were not using their capital. They were too conservative. Shell was doing great. They were going after all of these things. Now in 2017, you can completely flip that picture. ExxonMobil is, relatively speaking, very healthy. Shell is figuring out how to struggle with cash issues. And so the issue on that I find so fundamentally fascinating is, I agree this is the logic of what we're trying to do, and this is exactly what we're trying to do, but it seems like horses for courses, right? It seems like in go-go years, maybe being less conservative and more aggressive is more exciting and you get the good back pats, right? And then, of course, the bill comes due, and in difficult years like we've had the past 3 or 4 years, then all of a sudden it's like, well, why weren't you more conservative? I just find that fascinating. And this comes back to what drove me to want to have this conversation at the beginning. That economic analysis, that way of doing it, is exactly what should be done. That should work in environments where oil prices are high, and that should work in environments where oil prices are low. And it shouldn't really matter very much, because it's the logic of the process that's correct here, right? And yet, the application of the logic of that process kind of appears to be different. In different environments, different things happen. And that's what I love about this.
Well, is the next slide our evolving bargain slide?
Exactly.
So to Britt's point, the problem, of course, is he's correct.
That's a problem?
Well, let me point out that at this point I could give an easy answer if only people had listened to me in 2011 when I was trying to get people to think about what 2017 could look like. But that's the bane of my existence. The dilemma is stuff happens to interrupt that framework. Now, part of what companies are trying to do and have been trying to do, part of what everyone tries to do, when you're moving things from the what I can't control to the what I can control column, what you're trying to grapple with is the ecosystem that you're in, what we call the commercial framework. Because no matter what industry you're in, what business you have, or whatever, you can only operate within the confines of the rules of the game that you're part of, right? So the laws, the regulations, the opportunities, the capital market structure, whatever is available to you as you move forward with the opportunities as you see them. The dilemma is that a lot of the stuff that we have to deal with is really fuzzy and very tough to actually move into a risk mitigation, risk assessment process. And what Britt and I have talked about, as he's wrestled with this himself, and as we've looked at it, if you take a typical oil and gas industry workforce, well-trained, we do a great job of this here at UT, engineering, geology, even finance, accounting, whatever it is, park people in that business. You give them all of the tools and everything else, and then something happens in a situation. Oh my God, how do I do this? How do I get control of the situation? Am I going to lose the asset? Am I going to lose the project? How do we solve this problem? This is really the dilemma. A lot of the source of the risk comes from how all of these bubbles move around. I mean, it's really hard to draw a picture of kind of what society looks like, or what the political and socio-political structure of any place on Earth really looks like. So what we came up with were just kind of all the things that we know exist. We have political systems and laws, policy making, regulations. We have design of markets. Are prices free? Are they open and set through supply-demand interactions, fundamentals as we like to call it, or is something else going on, or governments intervening? All these bubbles are constantly bouncing around back and forth. Somewhere in there, the company, the investors, have to get comfortable enough that they can see something that looks like a place, an equilibrium, I don't know what to call it, that's a comfort zone where you can make the investment. People call this license to operate. The really bad part of that phraseology is that it's not always clear who's giving license. I mean, this is really a problem. I mean, if you're going to drill a well in Texas, you go to the Railroad Commission. Okay, that sounds easy. But in a lot of situations, the license is coming now from non-traditional sources. You have to be accepted by other audiences and other stakeholders. And that's actually a much more difficult thing to accomplish. So I've done a good job of killing my own previous nice little cute framework that Britt rightly pushed back on with what I know about how the world actually works, and what the real problems in risk management and risk mitigation are.
I used to think I need to disavow. I do this every time I give a talk. I have to disavow my PhD thesis, okay? So my PhD thesis was nonlinear stochastic optimization. And the fundamental premise of my thesis was if you could just model something correctly and get the details right, then you could find the right answer. Even if there was a lot of uncertainty in it, even if there was a lot of probability, if you could just get it right, you could get the optimal answer. And I just completely don't believe that anymore. And that'll lead, but I don't. When human systems come into play, that's kind of why I differentiate between technical risk and non-technical risk, right? Because in technical risks, I think you can model, I mean, physics is physics is physics. And I think you can do a reasonably good job of modeling that. But when you get to a bubble like this and you're trying to figure out how you should organize your project, how you should budget your project, who you should use for your suppliers, how you should do it, I just think the fuzzy human side gets so complicated and difficult to model that I think this overwhelms kind of this idea of optimality. I would actually like to talk about a robust decision rather than an optimal decision. And so we'll keep on going.
Well, I'll add really quickly that my PhD work was on the political economy of natural gas restructuring in the United States. So I'm completely the opposite end of the spectrum from Britt by the time that I got around to messing with all of that.
Yep. Now, you saw Michelle's model. We don't need to go through this in any great detail. But the classic way somebody tries to manage risk, or let's say the classic way one tries to decide whether to engage in an opportunity or not, is through economic analysis, right? And there's all the stuff you learn in school. If it's a big capital project, you're probably talking about things like CapEx and OpEx, and you're probably talking about what kind of revenue stream and what kind of prices and all that other stuff. So that model that Michelle presented at the beginning, it's so clean. It's exactly what we teach in our finance classes. Half of you probably taken a finance class, maybe more than half of you from us. We put all of our metrics up there. What's our net present value? What's our internal rate of return? We go through, we do our analysis and do all our cash flows, and then we decide, hey, look, what do we have here? It looks like net present value is $370 million. Is that an acceptable return on this? Or the internal rate of return is 19.5%. And we would kind of compare this opportunity against other opportunities, and we would pick the best opportunity. I have no beef with that as a fundamental principle. I think that's what we're teaching is the right thing, what Michelle teaches is the right thing, what we do is the right thing. The question is, does it explain the decisions that people are actually making, and how does it take into account difficult to quantify, difficult to understand, kind of fuzzy risks, if you will? And that's the heart of the matter. And we've had many, many conversations on this.
So I think you should just move to your next one.
All right.
Because that sets you up.
All right, I'm moving to the next one. All right, so is a sensitivity analysis enough when we're doing this? Can we go through and do a waterfall chart? Can we go through and try scenario A, scenario B, scenario C, and then try those out? Do we do a probabilistic analysis? Y'all have all seen this stuff, right? So then, again, does this work? And so I'm not sure. And that's really what this slide is about, is trying to raise this question because, like I said, I disavowed my thesis and I disavowed the idea that we can have an optimal solution. So what about SOX reporting issues? I've been involved in a lot of discussions with consulting firms who work in the capital project space in the oil and gas industry. And a question we keep asking ourselves, although it's never risen its head so far that we're aware of, is if you're an oil and gas company and you tell your shareholders you're engaging in a project that's going to cost $17 billion, and that project ends up costing $51 billion, are there SOX implications? I mean, did you misrepresent the risk? I mean, why hadn't that gone to court yet? Those are the kinds of things I wonder about on stuff like that. I don't know. Any ideas on that? I mean, because we wrestle back and forth, and we just don't know what to make of this.
I have a right to an attorney.
Okay, all right, fair enough. And then, perhaps the most difficult one of all is this term, and I want to jump to a comic that Michelle has up here, and then I want to have a conversation about it. The things that really seem to mess us up have gotten labeled with this term black swan risk. Out of curiosity here, just out of curiosity, how many of you are at least passingly familiar with the term or the concept of black swan risks? Raise your hands. Okay, less than half. All right, I'd like to talk about that. So, Michelle, let's jump to this.
You want to go straight to that?
Yeah, I want to go straight to this, and then we'll go back up and talk about how it's actually being used.
Okay, so this is fun. This is my all-time favorite black swan cartoon. I don't know if everybody can see this. This is also a bow to the Bureau of Economic Geology, where we do have very good geologists who are very interested in what would we call extraterrestrial geology. Levi Shoemaker 9. Does somebody remember that? Or Shoemaker Levi 9? I forget which way it goes. The comet that smashed into Jupiter. So in the little bubble there's the little dinosaur. And the little dinosaur is saying, good grief, not again. Do y'all understand this? What do we think happened actually to dinosaurs on Earth? I mean, most theories still revolve around the fact that we had an impact. That impact, we think, actually created the crater that led to the largest oil pool in Mexico. Cantarell is related to this. What is a black swan, really? Is it something that is completely unknown? This is probably where we've had the most strenuous discussions over the years, I guess. Or is it something that we know could happen? The problem is we don't know when or how. This is a dilemma. We have meteor impacts on the Earth all the time. Thankfully, they're mostly small ones, and we're still here, and we can actually read about them in the news and all of that sort of thing. Every few thousand years, though, the Earth is vulnerable to a major impact. And we can trace this back in the geologic history of the Earth and see what's happened. But we don't know when, we don't know how, we don't know where, we don't know with what force, we don't know with what consequences, but we know it's going to happen. And this should set you up pretty well in terms of this kind of risk with that kind of uncertainty. How on earth do we think about this? Right. And even worse, how do we bring it into planning?
So let me show you something just to try to get an idea behind what these so-called black swan risks and why these are so difficult. Okay, I'd like to show you an example, and then I'd like to back up and talk about why we're running into trouble with these kinds of problems in large projects and small projects as well. So perhaps the easiest way to do it, yes, you're going to have to look at some math, okay? So just hang on for a second, okay? Bear with me because this is important for a moment, okay? I can't completely disavow however many years I spent in school. All right, so here's the deal. We've got a simple project. Well, maybe not a simple project. We've got a project and we're trying to figure out how to budget for this project. Now we know there's some uncertainties in the cost of the project. This is just cost here. We can do the same thing with schedule. And so maybe what we've done, if you take a look at it, maybe we've identified some pieces of scope and we've identified some work we have to do, and we've come up with an estimate for the range of possible cost of each of those line items of scope. And what we end up with is the bottom picture down there, which I would call a range estimate, saying that the possible costs for this project range in some sort of distribution, and they range on the low side. Typically, in the oil and gas industry at least, we generally talk about P10 to P90 range. So the low side, the P10 side would be, yeah, we think there's a 90% chance it'll be higher than this and only a 10% chance it'll be lower. And then on the P90 side, that's kind of the upper bound of what we're planning on. 90% chance it'll be lower, only 10% higher. So we often talk about projects when we're budgeting or scheduling them. Remember, I'm coming from the project director perspective on this. We talk about them like this. And then we try and give a range of possible outcomes so that people are comfortable. If we engage in this opportunity, this is the kind of cost range that we can expect. Now, those of you who've ever been involved in projects, you know that at some level you can't just say, well, I will give you a range budget. You got to pick a point. And the typical thing, of course, is people, I don't know why, we could debate this as a separate topic here, but people love the P50, okay? They just love it. So you always budget at the P50, and maybe the budget for this project would be $44 million, okay? Not a $20 billion project, a $44 million project, recognizing there's some range around it. Now here's the question that I'd like to kind of throw out there, and really what becomes the essential problem in this industry with respect to these difficult to quantify risks. They generally are of relatively low probability, therefore you tend to want to ignore them, but if they do happen, they tend to have pretty significant consequences. And so this presents this dilemma. What do? I'd rather ignore it, but if I ignore it and it happens, we got a pretty significant consequence. So I made something up, just to give you a little example here, okay? Now, this is going to test and see if you remember your math at all, okay? So this cost estimate you see down there does not include those three risks. And somebody has come through, an analyst, somebody who does what I used to do and used to believe in, has come through and said, yeah, I think I've identified three risks that we might have to worry about. And yes, I know it's a guess, but there's techniques for trying to guess. I think maybe one of those risks has a 10% probability, and if it happens, it's going to add $10 million to our project, and so forth. The question that I have for you, kind of conceptually, which introduces the concept of tail risk, which is the central part of what we're talking about now, is what do those three risks do to that range estimate down at the bottom? How do they distort this thing? That's the essential question. And those of you who remember your math, okay, basically think of the P10, that's the optimistic outcome. Well, in the optimistic outcome, none of those things happen, right? So it shouldn't have very much impact on the optimistic outcome of the final cost, right? All right, the P50. Remember, everybody loves to budget at a P50? What should happen there? Well, if you don't remember your math, you take the expected value. So the expected value would be 10% of 10 million, that's a million. 20% of 5 million, that's another million. 5% of 10 million, that's 500,000. So it's going to change the budget, if you will, the 50-50 estimate, by about $2.5 million. What happens to the P90? Remember what the P90 means. It means worst case outcome. In the worst case outcome, what happens? All of these things happen. And that's exactly what happens, okay? So you see that blue curve right there? Right now, this picture, although it's simplistic and it's got math in it, this picture, I think, gives a reasonably good illustration of the fundamental challenge that anybody who's going to manage risky projects that have these kind of low probability, high impact risks have on them, which is, what do we pretend is going to happen? Do we pretend it's going to be the black curve and hope those 3 risks don't happen? Do we recognize it might be the blue curve, but then no project's ever going to get through the gate because nobody's ever going to live with a project that says, well, it could cost $40 million, but it could cost $80 million. And does this represent what's actually happening in the industry? So a colleague of mine studied a bunch of large industrial projects, some in the oil and gas industry, some not in the oil and gas industry. And he was trying to understand how tails were actually looking. And he went to the publicly announced P50 cost at sanction, and then the final cost. And he tried to understand across this portfolio of projects how big was the tail compared to the promised cost at the sanction. All right, just as an interesting thing. Now it's hard to get this data. A lot of it is very sensitive data, but he was able to get enough data to answer an interesting question. Those of you who are in the oil and gas industry, or any kind of formalized industry where we have project management, the typical rule of thumb at sanction is that the P90 is about 15% above the P50, and the P10 is about 10% below. So you may have heard this if you're in this industry. You may have heard at sanction, we have a budget that's a plus 15 minus 10 budget. That's a very typical kind of discussion that happens in this industry. Well, when he looked at the data, instead of the P90 budget being 15% more across this large portfolio of projects on aggregate, it was 3 times the P50 budget. All right? So what that means is, at least anecdotally from the information he was able to do, that tail is real. That tail isn't a little tail. That tail is a huge tail. What's causing it, and what do we do about it? And that's what started my conversation with Michelle. Is, Michelle, what do we do about this? Because if the business decides to go ahead and try and do one of these oil and gas projects, and we take a realistic assessment of all the risks in there, we try to list them, we try to come up with the budget, and we go to the executives and we say, hey, executives, here's a project. We hope it will cost $4 billion. If we're lucky, it'll cost $3.5 billion. But there's a bunch of risks out there. It could cost $15 billion. We're going to get laughed out of the room. What do we do about that? So, I mean, that's the essential issue here.
It is the essential issue. And I think maybe, let's see, to illustrate it, let's go to...
You want to see the black swan thing?
No, let's go forward. Let's go forward to, no, back.
Back.
There we are.
Okay.
So at this point, when you think about it, we've really got a dilemma, right? We teach people how to do things. We have come up with all sorts of ways of perfecting the hard analysis of projects. We've been able to at least achieve an understanding that we've got both technical and non-technical risks. So we have different sources of risks. We've had distinct experiences that we can label as black swan experiences, and we think that actually we can pull that into an analysis. But we know from experience that something isn't working somewhere. Mm-hmm. Something happened somewhere that caused the state of affairs to be where they are. And I think Britt was maybe underplaying this a little bit, because when you talk to people about where things stand in large-scale industries like energy, mining, infrastructure, and even in some technology businesses, software development costs and things like that, what you'll hear are repeated patterns. It blew the estimate, blew the cost estimate, blew the budget estimate. Clearly there's something going on. So one line of thought that I think is worth consideration is how we got to the decision in the first place. What's actually going on in the room as people are evaluating the data and evaluating the information and reaching conclusions. And this is where, to go back to this word that we tossed out, heuristic, this funny word, the role of conditions that we select to be able to make decisions in the face of very large uncertainties about risks is, I think, something that we can actually think more about. Fortunately, we have guidance from a lot of work that's been done historically, Nobel Prize winning work, that has unpeeled, unpacked human behavior in a way that allows us to see how people actually perceive risk and how they think about risk and respond to it. And we have, over decades now, a series of experiments that have been done, lots of work about how people make decisions in different kinds of settings to be able to see this in action. And we've been learning some interesting things. And so one of the first things we've learned is that we have to revisit this word rational. What does it actually really mean about someone? And how what is that person really maximizing and trying to optimize and trying to get out of the deal? We've learned a really, really important thing about how averse we are to risk. But this is funny, because if we were really as risk averse as we know that we are, then we wouldn't see any of these projects going forward. But it might explain something about how they end up. This is a real challenge.
To interject for just a second?
Yeah.
If you don't mind, I can't tell you how many times I've had a conversation, just to go back to this, I've had a conversation with a project director at a major oil and gas company, and I said, you think the range is this blue line. And he or she says, I can't tell them that, okay? I can't tell them that. If I tell them that, it'll never fly, so I can't tell them that. I got to tell them the blue. That's what Michelle's talking about here. What is it that's creating this? Why can't I tell them that?
So have you ever talked to anyone about regret? Because when I put this slide together, I felt like, we really need to acknowledge this. Because this is another thing that we've learned about people. We're more afraid of regret than anything, which is what propels us forward. The regret of missing an opportunity, the regret of doing something that some other company is not doing. I mean, this is really a powerful sensation out there. And what happens is, because we know that we've got a problem with the math, and we know that we've got a problem with the rigor of our decision making, or how we look at data, or other things, what we tend to do is fall back on heuristics. So my explanation for corporate culture, when we look at different organizations, or even when we look at different universities, since we're business organizations, I think, why you see certain groups actually moving in certain directions is because internally they got comfortable with something. Right. Internally they got comfortable with how we're going to talk about risk and how we're going to talk about uncertainty, how we're going to have these meetings with those project managers so that we can make decisions and go forward. And that's what the heuristic is. The heuristic is the condition that the company got around to accepting through probably many, 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 many years of how to view things in order to be able to move forward. Now, there's some fun stuff in this. So if we go to the next one, here are some things that you have to watch for when you're in that room talking to those project managers, or when you're in planning environments. Our minds are really, really, really bizarre things. I have repeated this experiment with groups like you, and it works every single time. And you can buy Dan Ariely's little book, which is a wonderful book, Predictably Irrational, and you can see a whole slew of experiments like this. If I started from nothing, we had not had this discussion at all, because now you're aware, and I asked all of you to think about the last 2 digits of your Social Security number, and then I put you through auctions. You're going to bid on different kinds of products. I guarantee you that most of you will bid higher on things if the last 2 digits of your Social Security are higher than they are lower. I would make that bet in a heartbeat, and I would win this bet. It happens over and over again.
Just because my Social Security number is higher, or is it because you anchored me to those numbers when you started the conversation?
You anchored yourself.
Okay. Yeah.
Because I asked you to do it.
Right.
I asked you to think about the last 2 digits of your Social Security number, and guess what? It's stuck in your head. Mm-hmm. Okay, the thing is, marketers know this. And when I'm reading the book, I was talking with a colleague of mine who's a crackpot, not crackpot. What's the right word? Crack marketing expert, right?
It's on the video. She called her colleague a crackpot. Okay, so.
For sure. Why do we price things at 99 cents? I mean, this has been through the marketing world ever since we've come to realize that anchoring is a really real thing. Yeah. We get anchored by information, and it's hard for us to not let that influence how we think about things. You have to be extremely disciplined in order to not get anchored on things. We see this in commodity markets all the time, by the way. we see prices accelerate in one direction or another as people get anchored thinking, well, the next price is going to be higher or lower.
Right.
And you see markets accelerating as you go through price cycles as a result. Let's go to the next one.
Can I
real
play
quick.
this back to
Yeah.
you to make sure? Okay, so the logic of our conversation, we're not, this wasn't rehearsed, okay? So we're not rehearsing this right now. We wrote emails back and forth trying to say kind of key points. But let's see if I can put this together. So people within corporations make decisions partly by data and analysis and logic, but at least partly by corporate culture. And a definition of corporate culture is the heuristics by which this company makes decisions. And I would say that's a learned behavior, right? So Corporation A and Corporation B, they've had different experiences over time. Therefore, they've created a set of heuristics internal to themselves that say, this is how we do things here. And then somebody becomes a part of this corporation, and one of two things is going to happen. Either they inculcate this heuristic and they start believing in it and they do it that way, or if they don't, they're never a good fit for the corporation, right? So they leave or they get sidetracked or sidelined or something else. And so now you have kind of this series of heuristics that anchor the decision process that you're making, and that can be a possible explanation for the difference between Company A and Company B, just a different set of heuristics that people have anchored on. Is that a reasonable way of saying?
Or maybe something else that we've talked a lot about. So one of the things that we've discussed is how people evaluate projects. How do you know how a project's going to perform? On the basis of how the last project performed, right? So Britt's, really sent a lot of signals to me and information to me along those lines. What is it that the project manager has to get anchored on in order to make a decision to go forward, knowing that blue line is not the line that we're talking about. Mm-hmm. We can't talk about that one. We can't let that one in the room. Line, yeah. So what do you fall back on? You fall back on the previous experience. Mm-hmm. And so that's a form of anchoring that I think would actually be a better illustration. But it's not the anchoring that's the heuristic. It's how we're making the decision. This is a behavioral problem. The problem is this is what we tend to do. This is how our brains tend to process information. And we have to be really aware of that and recognize that we're doing that. Go to the next little slide. So this one's fun because a lot of the stuff that we struggle with is known. A lot of the bias that's in that room as people are evaluating projects is known. The problem is, how do we overcome it? So one of the biggest ones is confirmatory bias. You believe what you believe. You believe the information. You're selecting sources of information that confirm your beliefs. Companies have a terrible time getting away from this. I see everybody jumping into an oil and gas play. That must mean that it's good. So I'm going to go in and I'm going to invest. And it's such a hot market. Probably what happens is a lot of the due diligence doesn't get done the way it's supposed to get done. But I'm trying to defend the entry to my investors, to my management team and everything else. What am I going to do? I'm going to look for every bit of information that confirms the play. When in fact, what I should be doing is looking for exactly the opposite, right? I should be trying to tear it down, tear it apart, and see why it doesn't work. Well, there's a whole bunch of stuff like this.
To throw that in, that's exactly what project manager, you can just see it, okay? So they know that if they report those risks, then they're never going to get funded. So they downplay it. They seek out the information that supports the idea that this won't happen, so we don't have to worry about it. And they seek out the argument that says if my project should go through, rather than seeking out the information that might suggest it shouldn't, right? And that's exactly what Michelle said is exactly what you see in the behavior of these senior project managers.
Or what did I do in the very beginning of this? I'm exactly guilty of what you said. When I built my framework, that was a siloed framework based on how I think about things, right? This is an enormous problem. We talk about silos and boxes and everything else all of the time. Availability heuristic. This is another really bad one that I see over and over again in business organizations. I am going to tell you what the future might hold for something based on the frequency that I see it happen. Nothing could be further from the truth in terms of what could be the actual outcome. So these are us. I mean, this is how we are. We are a mess, as I like to say. The good thing is that, fortunately, we've learned how to conquer some of this stuff.
Well, you have to be mindful of them.
And I
first
wanted
of
to
all.
show you all, a couple of easily accessible references to be able to understand this better and think about it in your own lives. The Nobel Prize-winning work in all of this was done by Amos Tversky and Daniel Kahneman. One of the best lectures I ever heard in my entire life was by Amos Tversky at Rice University years ago. These guys thought deeply, deeply about this stuff. How do people make decisions in the face of uncertainty? Michael Lewis's book, which came out last year, The Undoing Project, is fun to read because it's the story of these guys. They were in the Israeli army. One of the main problems that they were working on for their government, for the army, was how do we decide who can actually be a successful soldier, given the situation in the 1960s? How do we make that selection? How do we pick people? Do we pick them on the basis of data and analysis? Or do we pick them on the basis of gut? Is that our heuristic? Do we think we understand the profile of someone that could be a successful person in this situation? Or can we rely on data to do this? One last little thought. Are there any Cubs fans in the audience? So there's a great new book out on the World Series last year. And the reason that it's worth looking at is because it's this stuff in essence. What the Cubs actually ended up doing was abandoning the statistics that baseball teams have invested in so hugely. So if you're a Michael Lewis fan and read Moneyball, you know what I'm talking about.
That was a great book, though.
It was a great book. It was a great book.
And a movie, yeah.
But what happened was everybody started doing it. All of a sudden, so this is a real challenge for you to respond to. All of a sudden, everybody's internal practices are so good that everybody's able to go out there and design and select baseball teams that are going to be competitive. So how do you get a comparative advantage when everybody's doing the same thing, running the statistics, collecting the data, all that kind of stuff? Well, what the Cubs did was they fell back on gut heuristics. What does the profile of a successful World Series team look like? How do I find those players that fit that profile based on my heuristics for work ethic, performance, all that kind of stuff? Okay, now we've really made a mess for you, right?
Okay. Now, this is Michelle's favorite example, so she gets to explain it, and then I want to talk to you about a heuristic also.
So putting these things together in a way that's maybe a little bit different. There was a terrible earthquake and tsunami event in Japan, as everybody knows, in 2011. And in analyzing the situation, what people realized was that we were presented with a situation of two companies with large-scale nuclear projects in the region that the earthquake happened. And what those companies had done was taken completely different approaches. They made completely different decisions based on commonly available data about how to build those projects.
So they both had the same data.
They both had the same data.
Faced the same risk, but they made
both
different
faced
decisions.
the same risk,
Okay.
but they made completely very different decisions. It boils down to this phrase that I heard from actually an LNG industry expert. My kingdom for 1.5 meters, because the result of the events in Japan actually drove where things are in the LNG business today, the liquefied natural gas business today. But this is a picture of Fukushima Daiichi, post-catastrophe. And it's important, I think, to understand, too, the struggle around this whole situation. It wasn't a failure. It wasn't a nuclear energy failure. It was a failure of decisions about how to build the nuclear plant, which is an important social perspective on all of this stuff. So let's go to the next slide, because this is really kind of the interesting part of the story. Fukushima Daiichi was kind of at the southern end of the earthquake zone. North of Fukushima is the Onagawa nuclear power station. It's operated by a utility called Tohoku. Fukushima is owned and operated by Tokyo Electric, which is one of the largest electric power utilities in the country. Both of these were built in the late 1960s, early 1970s. The Tohoku civil engineers who were doing all the site work went out to Sendai Plain. So in this part of Japan, there's a very broad, open area, a combination of farming, wetlands, that sort of stuff near the city of Sendai. And they took core samples and discovered in the core samples that there had been tsunami events associated with earth movements that were much more severe than what had been understood up to that point. In specific, there was a tsunami event in about 800 or 900 that had caused a wave that was about as high as what Japan experienced in 2011. But the rule at the time was a roughly 9 meter site elevation. That's what the government had on the books. The tidewater is the initial site elevation, or I guess the natural site elevation, was 3 meters. The Tohoku engineers convinced their management to approve the budget to build Onagawa at almost 15 meters, 14.8. TEPCO, on the other hand, had all the information from the core samples, everything that the Tohoku engineers, plus everybody who's ever studied Japanese geology and everything else thought they understood about tsunami events, chose to build Fukushima at 10 meters. And the tsunami rolled in at 13.
Right.
Now, there were a lot of other things that TEPCO did that were sort of, in retrospect, not very good decisions, probably related to budget, who knows. The seawater pumps were actually at tide, so they weren't able to operate them. But worse, the backup diesel generators that would have allowed for a normal shutdown of the Fukushima units were too low as well and were damaged by water and weren't able to function. 2 different decisions by 2 companies faced with the same information and different results in the 2 different locations. How do we analyze this?
I want to give you a cautionary pause right now, because the temptation after the fact, those of you who've ever had an MBA class where you had case teaching, right? You know, the professors usually hesitate to give you the outcome because after you see the outcome, it seems to justify the decision along the way, right? But we have a phrase in risk management which is called the risk manager's dilemma, right? And the risk manager's dilemma is if you protect against something that never happens, you look like a fool, right? If you protect against something and it therefore doesn't happen, you just look like you spent too much money, okay? So in this particular case, one could argue that the northern power plant could have looked foolish if there hadn't been a southern power plant to show the outcome, right? And so what I want you to realize, this is not as simple as saying Fukushima happened, Fukushima was bad, I forgot the name of the other company, but they didn't have the problem. This is a really, really hard problem, because what do you do if your project cannot go through if you build, you spend an extra $1.5 billion to build a larger wall instead of a smaller wall, and you think the likelihood of that is so small it can be safely ignored? After the fact, you can always say you should have done it or shouldn't have done it. But in the heat of the moment, that's a really hard decision. I don't want you to trivialize. This is a really, really hard decision. And I'm gonna make a prediction here. In the environment that the oil and gas industry finds themselves in right now, projects are under tremendous cost pressures. And so almost all the big IOCs, they have a series of engineering specifications that have been built up over time. They've started with the base specification and then something happened, so they added something on top of that specification. And then they added something on top of that specification until at 2000, let's say 2014, the specifications as provided by oil and gas companies for these projects were manuals 3 feet thick of what you had to do. And it adds an awful lot of cost over what's generally called the industry solution. And the non-big IOCs, the smaller players, they would often use the industry solution, and the big IOCs would use their specifications because to them that represented corporate knowledge of the things that could go wrong, so therefore they would be safe operators because they'd stacked, instead of industry standard specification that's a 1/2 inch thick, they had all of their added specifications that made it 30 inches thick. I am not exaggerating. What I am telling you, anybody who knows anything about this industry and what I'm talking about, I am not exaggerating. Right now, under the cost pressures, everybody is trying to cull back this stack of 30 inches down to the half inch, all right? Everybody is doing this, and the buzz phrase in the industry now is called minimum technical scope. And so in the industry, up until a couple of years ago, you had to start with the full set of specifications, and then you had to justify why you didn't need anything. So you'd start with everything, and then you justify taking stuff away to get to whatever's the safe point, supposedly, right? In today's environment, it's exactly the opposite. You're starting with the minimum specifications, and you have to justify everything you're going to add on top of the minimum specifications. Anybody who thinks those end up in the same place is fooling themselves, okay? And so the fear I have is part of this culling is needed, but how do you know? Go back to Fukushima, right? How do you know which of those lessons learned over time you can and you cannot remove? That's a difficult thing. I don't know the answer to this, but I promise you this is happening in the industry.
But I think we should put out another cautionary note, because at this point it might sound like we're suggesting that we might be giving up on safety protocols and budget management, and I have to assure you that that's not the case. That's sure been beat into us enough, I think, in the work that we're doing together. But it's true, because the dilemma always is the additional spending really going to pay off? I mean, that's really the uncertainty problem. And when safety becomes so ingrained in processes, in how people perform, and in metrics and other things, that becomes something that is of value. And the question is, how much more do I have to spend once I've gotten to, as you know, a fail-safe place?
Yeah, Michelle's right. I mean, she's more cautious than me on this stuff. I'm not saying we're all going out and building unsafe stuff, but I am saying
but the same thing applies to automobiles.
Is happening. Yes.
Safety in auto manufacturing, safety in appliances, home products. I mean, every industry has to go through this kind of a process. How do we decide, you know, what is really the right course given what we know about making the decisions, the black swan events, the things that we want to try to put into our control, how we're making the judgments and the decisions in the first place, to be sure that we have assurance, right?
Let me show you one last thing, and then let's open it up for questions, okay? So I would like to suggest that what I've seen is, this obviously comes from my math background. Those of you who have a math background, anytime we're trying to prove something like, does vitamin E work or not work? You know, does a low-fat diet work or not work? Does the data support this conclusion or that conclusion? Anybody who's ever had any formal schooling in this knows that the only way you can treat that mathematically is you have to formulate what's called the null hypothesis, the thing that you believe to be true. And then you have to formulate the criteria by which you're going to overturn the null hypothesis. And this has profound implications on looking at uncertain data. And I want to kind of, let me walk you through that, then propose this as a possible heuristic that people are using right now and actually explains a lot, and then kind of have Michelle close up with some thoughts and then answer questions. But what you have to understand, let's take something fairly non-controversial. Does vitamin E work or not work? Okay? Now, that seems like an obvious question. Let's have a whole bunch of people take vitamin E. Let's see if the people who take vitamin E are healthier than the people who don't take vitamin E, and then let's decide whether it works or doesn't work. Well, that's actually a really difficult proposition, because what you end up having to do is the first question you have to ask when you're doing this study is you have to ask the question, is my base assumption, it's called the null hypothesis, is my null hypothesis is vitamin E doesn't work, and the data has to be convincing enough to overturn that for me to justify that it does? Or is my null hypothesis vitamin E works, and the data has to be compelling to make me change my mind on that? That is an absolutely fundamental question anytime you're trying to analyze data on this. And that explains why The American Medical Association may look at exactly the same set of data as the vitamin E supplement manufacturer does, right? And both of them use exactly the same data to demand that they've proven their point, and they're proving opposite points. So just to kind of put that in front of you, what do you think the null hypothesis of the American Medical Association is? It doesn't work unless the data proves that it works. And then what do they have to set as the threshold to overturn their null hypothesis? They want to be really sure. So they may require P99, right? Now, what's the supplement company going to set as the baseline? All right? It works. And they're also going to make it difficult to overturn the threshold. Or if the supplement company has hired a researcher to do this study for them, and the researcher demands to be independent, the supplement company can say, okay, but your null hypothesis has to be this. Or they can set what it takes to overturn the data to be a different thing. So just realize this is really important on this. And my presumption in this is that if you look at companies, I think corporate culture, at least partially, determines a null hypothesis in undertaking a risky investment. So my argument is this. When you look at differences between, let's say, what's considered a conservative company versus a company that's considered, let's say, more aggressive, more risk-taking, it's not so much they use different analytical tools. It's not so much they do different economic analysis. It's none of that. What it really is a more conservative company might have the null hypothesis, I'm not going to invest in this unless you can show me data that convinces me otherwise. And a more risk-taking company is going to have the null hypothesis that says, yes, I want to engage in this because it looks like it has a good return, unless you can show me that the risks are such that I shouldn't. And make no mistake, these are fundamentally different differences. I mean, fundamentally different ways of looking at things. I teach this in my class. I'm going to stand by it. I think at the end of the day, when you look at Japanese automobile manufacturing versus American automobile manufacturing, and you look at historically what's happened, and you go, why are Japanese so good at making these things? It's not because American managers are willy-nilly, no, I hate quality and everything else. What it is just think of the fundamental Japanese null hypothesis. I am going to make an investment to improve the quality of this particular product unless you can show me data that tells me not to. And I think we teach exactly the opposite in our MBA programs. I think the fundamental thing we teach our MBA students is don't spend money unless you can demonstrate that it's worthwhile. So I think that's exactly how we get to this over time. A series of decisions over time, a different null hypothesis. I'm not saying we're wrong and the Japanese are right, because the Japanese are really good at making cars and we're better at Google and Facebook and other stuff, okay? So it's just different null hypotheses, different allocation of opportunities, different allocation of capital.
And I guess I would add, as we think about how people approach this null hypothesis problem, is to just bear in mind that we're human. To a large extent, we create our tail risks through the kinds of decisions we make, the things we pursue, the strategies we put in place, the choices we make. And that's not a problem. That's not a problem. The problem is to know that we do it, and then to try to figure out how they are. I would add a caution that we can have as a societal view of risk across lots of small projects that can be the same as larger ones. And I think the Japanese, in particular, have been learning this lesson post-Fukushima, because there are an aggregation of risks associated with how to move forward out of all of this, especially if you want to move forward in a different way, which is the debate that's going on in the country. But there hasn't been an assessment of risks associated with alternatives to where Japan was in its energy picture before all of this.
This is a truism.
And this is really a problem.
Your response to a risk itself creates its own risks, right? And so if Japan says no more nuclear power, then all of a sudden they're subject to all of the LNG cost risks, the energy risks, and everything else. So responses to risk create their own risk. I exactly agree with what you're saying there.
And to your point about the consequence of events, This isn't just in corporate boardrooms and senior management groups, this tendency to not want to spend money or to be cautious about things that are low probability but high consequence. This is just a problem. To pay for the insurance of that kind of black swan event is really expensive. And a lot of decisions that we make beyond just an individual business or household, society is at large again, really relate to that dilemma. Do we, people, are we willing to spend the money to be risk-free of every potential event that's out there? Or do we figure out how to adapt and live with it? And then the final one, which is, I think maybe an appropriate end for this long conversation, we have no corporate memory. And this is something that I really worry about a lot. So we've talked about a lot of stuff today that's learned experiences. I mean, these are there's documentation, there are internal things related to decisions that people make. Too often, it dissipates. Too often, especially in the business world, people move on from large project experiences. The team breaks apart, people retire, whatever it is. And then you're faced with that decision all over again, and you have no corporate memory. And again, this is true both at a smaller scale as well as at a larger scale. This is, I don't think a business program can fix it, but...
Anecdotally, the Shell Project Academy that started in 2005, it's a consortium of 4 universities, and it had the funding and the attention of the CEO of Shell at the time. There are 2 people currently involved in it out of hundreds that retain the memory of the entire thing. One of them is me, okay? And there's another UT academic, and there's 0 Shell people who have even been involved in the last 5 years. So whatever knowledge has been created there resides in me and this other guy, right? And it's absolutely true.
My team and I have spent many, many, many years coaching people in other countries on best practices associated with energy as they restructured. We have a grant in Mexico right now that we're implementing. We're in the 2nd year of to do exactly that. Work with the energy ministry and the regulatory bodies in Mexico to try to help them understand how companies make these decisions, what the common practices are, safety assurance, how to achieve that, all of that sort of thing. What I know from experience is that probably
2 years from now, yeah.
90% of the people that I'm interacting with now are going to have moved on to other things. At least they're still in the population. That's one way to think about this. But that is the reality. And the question of memory and being able to transfer knowledge and all of that is really kind of a crucial one.
We blathered for most of our time. Any pressing questions? We're happy to stay afterwards and talk a bit too, but any questions you'd like to ask?
Or reactions.
Yeah, reaction.
Thank you. I think it was on slide 15 or something. We started talking about, you showed your mathematical model and you had your distribution. Yeah, can you give us some insight as to how you would come up with the probabilities of all these events? That's sort of pivotal to doing any of this analysis.
So actually, the truth is there are techniques for this. Okay, I didn't want to get into. She already accused me of wanting to do a capital budgeting allocation session. Okay, if you want afterwards, I'll give you a quick answer, and then if you have questions afterwards, then I'll give you my email and just shoot me an email. But the answer is we do have ways of doing this. And I would say the basic idea would be some combination of the Delphi beta technique where you can actually sit down, you can go through risk workshops, and you can talk about at least qualitatively the relative magnitude of those. So I don't think it's hopeless to do this. I think that you can't believe the distribution you end up with precisely. Nonetheless, you can get a sense, is this a really big tail or is this a short tail? And yes, we have techniques for doing that.
Have you carried your decision process through NOCs, particularly in the Middle East, where there's significant social, economic implications, as well as the cultural differences in decision-making in and of itself, where saving face is everything?
I'm going to let her speak to this one.
Well,
she was invited to be the king of that.
You're not off the hook on this. I've spent a lot of time with national oil companies and national electric power companies in my career, and then here in the business school in exec ed, we've spent time with national oil companies that find their way to UT for training and professional development and all of that. They are clearly different animals. One of the most interesting things to look at is situations where national oil companies have transitioned from their old version of what they were, a provider of social goods in a country, to a commercialized entity, and how the decision making has to evolve with that. A lot of them are very good at actually picking up on the nuts and bolts and implementing them internally, but still have learning curves on all of the other stuff that managers in the commercial companies have learned over time about risk and uncertainty in the business and how to manage risk and uncertainty in the business. But they are, they can pick up the methods. They can build the probability distributions as well. They can do the risk workshops as well. But they've been in such a different environment for so long. It's a much, more interesting dilemma for them.
To speak to the Middle East in particular, I haven't done as much work there as I have in other parts of the world. We were going to do a huge project with Saudi Aramco, and then this is sidelined for a bit under the pricing problems. But one of the things that those of you who've ever worked in the Middle East and worked on a large capital project know is that everything is a lump sum. There's no discussion of any overruns. There's no, it's a done deal. If you blow your budget or you blow your schedule, you're not going to recover the money, and you will never be used again, right? So this is exactly what happens in the Middle Eastern way of doing it. And so ultimately, in high price signals, what we end up doing is we just build all that tail risk in, and we charge them a lot more, right? Today is an interesting question about whether I would even undertake a project in the Middle East right now, because I know there's tail risks. I know I'm not going to get any recovery if things go wrong. I know things go wrong in this. So I want to stay away from that. It's more interesting to talk about the Chinese, because they're interesting. Michelle and I have worked with, now it's all three of them, all three of the major, the Chinese NOCs, and they're not like the Middle East. They will accept overruns, they will talk about risk, but they are quite hierarchical in certain ways. So it's interesting.
One last question. This is a bit of a long-winded question, but
we
it's
were
kind of
long-winded, so.
I have a very good question at the end of this, and it's kind of relevant to what has happened this week. Obviously, there's a terrible tragedy on campus that happened right outside Gregory Gym. Mm-hmm. I happened to be in Gregory Gym at the time, so they put us on lockdown inside the gym. And here I am inside on a basketball court, getting texts from my friends. There was a stabbing, there was a shooting, there's 4 active shooters on campus. Right. I don't know what kind of risk there actually is. It's really hard to understand. Yet there's people playing pickup basketball on the court like nothing's happening. Right. And when they finally release us and I'm walking home, I'm texting my friends, hey, get off campus. And they're saying, UT texted us, there's no ongoing threat. There's nothing to worry about. And I get back to my apartment, and my roommate says, I'm going on campus to study. And I'm generally a very risk-averse person, but I was wondering if you could speak on the difference in tolerance of risk between people.
Read the books that I suggested. Right. Honestly, Kahneman and Tversky and many, many others who followed them and expanded on their work have thought very, very hard about that. And the answer is absolutely. People have different views of risk and different tolerances and different ways of perceiving them. And we spend a lot of time trying to group people so that we can actually build a risk assessment process that makes sense for a project. But in fact, it can be very individual, and it's often hard to figure out why one person would look at something one way and another person at another way. That's the essence of the conversation, really. There's not a real easy answer to that, but you should know that that there is a huge amount of work in that arena that you can always dip into if you're interested.
I'll tell you, we got to wrap up, but again, I'll give you my email on this. I'm happy to talk with you. I'm about to go to Singapore in 3 weeks to deal with capital project risks, and there's a little bit of, there's some games you can play to kind of demonstrate exactly what you're talking about. Some people think about the best outcome and live the world as if that's it. Some people worry about the worst outcome and protect themselves against that. And there's ways that we can try to determine that, but there's absolutely a difference. So, yeah. I mean, that was a weak answer, sorry, but if you want to talk later on, I got lots of stuff on it.
All right, with that, thank you so much, Britt and Michelle.
Thank you, Michelle.
Great job, don't you think?